the basic reason for this being dear to me is I love simplicity. There is something, when we talk to a new person who is not invested into equities, and when we start talking to him that you have opportunity to invest in equities, the first that we have to fight is the fear that he has. Somebody lost this much, somebody lost that much. It is a complex thing. I was into a group where people were teaching me charts. I was into a group where people were teaching me mathematical formulas and how to find a good company or a bad, how to identify the company I am invested in is getting bad. So these things are quite common, prevalent, and these are factual things one needs to be aware when he invests into equity. Now, if we look into the history of equity markets world over, there are mature equity markets like USA, UK. So when we look onto the history of these equity markets, the retail participation into equity market is into stages. The stage one, when retail investors gets into the market, buy shares and things like that, then comes the group PMS kind of things where a lot of people pool money and buy group of shares with the help of an expert. Then comes complex mutual funds, where an expert sits and says, I am an expert, I will buy good funds for good stocks for you, and this is a mutual fund and this kind of a thing. And this is how the broad-based retail investment starts into the equity. Now, after all this exercise, the finally that comes is the index investing. Now, what is index investing? Is it different from mutual funds, or is it same as mutual funds? Who should do, who should not do? This is my small aim over next 30 minutes to understand that why index funds is different from other kind of equity investments. This is just a disclaimer. This talk is just for educational purpose. No scheme which I would be talking during the talk is a recommendation. You have to apply your own intelligence and you have to judge yourself to understand whether this is a right tool for you to invest or not. Very blunt first slide. Who should leave this presentation right away and should not continue? Anyone who believes that he can make more than what others are making from the market should leave this presentation, because it's the biggest myth. One believes that I can make more than what others are making from the market. You can make what market is giving you, not beyond what market can give you. Anyone who believes I can choose better funds looking at different mathematical values of funds performance and my funds will do better than the others, he should also is not the right person to listen to this presentation. And third category is the person who believes that the technical and fundamental analysis of different stocks can make you identify multi-baggers and you can multiply money faster than others. I think this presentation will not be very fruitful for you. Fourth, very important, if you have short-term goals like 3 years, 4 years, 5 years, or 7 years, this presentation is not for you. If your goal is beyond 10 years, then definitely this presentation is going to help you. Now, what is the most important goal which is beyond 10 years and what normally doctors look into? It is usually the retirement or the post-retirement benefit one looks at. That is the basic aim, basic goal, which index funds can fulfill over a long period. There, I would, with these 4 categories, I always put this slide in my presentation whenever I talk about equities. It's a myth that the fast and furious earns more in the market. Making money is disciplined and a dumb job. If you are dumb and you have patience and discipline to invest, then only you will earn. You will not earn by buying, selling, or acting fast in the market. The here aim is to generate the wealth. I believe we all are professionals. Our basic profession is something which makes us earn. We need to harvest that earning into the wealth. So amongst us, tortoise will win. Amongst us, who has a patience to keep it, shut it, forget it, will win. Anyone who is looking for opportunities which will double fast or which will give you more returns will tend to sell those holdings that he has, and he will eventually create a less wealth. We all talk about evidence-based medicines. There is plenty of evidence-based investing, and it is heavier than active investing. I must tell you, all big names that you talk about in investing are evidence. They follow evidence-based investing. They are the people, those who accumulate. They do not sell what they buy. They buy with conviction and they keep it for years and years and they don't sell it. There is a huge behavior gap between the active investing and passive investing or evidence-based investing. In active investing, you look for opportunities to enter and you look for opportunities to exit that entry. But in passive investing, you look for opportunities where the risk and reward are managed by each other. That means when you invest, your risk is curtailed by the structure where you are investing, and any negative that happens into your portfolio is taken care by the portfolio itself without your action. This is called passive investing. Now look at the last 45 years of Sensex. In last 45 years, if you draw a yearly chart of last 45 years, this is the WhatsApp today got circulated in our group. Just around 11 a.m. this WhatsApp was there, this message was there in our group only. If you draw yearly profit and loss, almost yearly 70% probability is that you are in positive and still 30% are in negative. So 1 year investing into equity, probability is 30% you will lose money. In 3 years, still 11% there is a probability that your money is negative after 3 years of investment in equity. After 5 years of investment, there is a probability that your 4%, there is a 4% probability of being negative of 5 years investment. But when you invest for long means in market 10 years. It is not less than 10 years. When you invest long, the probability is 0 that the return will be negative. So if I always say invest that money which you don't need for next 10 years or maybe more than that, or maybe as a doctor, I always feel we have enough money for our daily expenses, for routine goals. We manage our routine goals very well with our practice, but it is the only one goal which is a problem for practicing doctors is retirement. And we should focus on a healthy retirement, and we should save, invest, and place our money in a better position so that the retirement is peaceful. Index investing. It is not different. It is not just another product. It is same as equity investing, what you do in any other form. Your mutual fund investing, index investing, they are same. They are not different. Index investing is the simplest form of investing. Why still people don't invest in index? Because nobody sells index. Nobody sells index funds. Why nobody sells index funds? There is no commission in index funds. That is why there is no seller, there is no agent, there is no advisor who tells to buy you index funds. Even all websites, rating sites, they don't give rating to index funds. They do not grade, they do not create a category of index funds. Very smartly, there are thousands of categories on value research, but there is no category called index funds category, that you can filter out index funds and compare within index funds. No, they will not do. Rather, they hide it. They push it down. As you start looking stars, you will not find any star in front of index funds. How old it is, how good it is, how good AUM it has, how consistent it is. So it is up to you only. The products which are not sold are to be bought. It is up to you to judge, find, and look for index funds from the sea of funds. Index is nothing different. Index is nothing. It is, as I said, it is not another product. Similarly, it is not a fancy thing. It is just the market, what it is. As it is, the market is copied into index funds. Now, let us look at what is market. Market, there are 2,000 companies which are traded on NSE regularly, out of which 500 companies are above 500 crore worth, and they are traded very religiously on NSE. Now, we can divide these 500 companies into 4 blocks. 1 to 50, 51 to 100, 101 to 250, and 250 to 500. So these 4 blocks are based on the floating marketing capital of these companies' value. That is number of shares into the market price. So number 1 company everyone knows is the Reliance. When last time I presented, its value was 14 lakh. Now it is almost 16 lakh crore. So this is number 1. Last company of this block is worth around 500 some crores. So these blocks are popularly known as giant caps, giant plus, or you can say large caps, or Nifty 50 and Nifty Next 50. This next means next to the first 50. This does not mean that they will become Nifty 50. This is the second block starting from 51st rank to 100th rank. Similarly, 101st rank to 250th rank, they are called mid cap. And the index which comprises of this is called mid cap 150 index. The formula of how these 150 will be adjusted into one index is given by SEBI, which is periodically changed depending upon the free floating capital value of every company. And it is a complete automated process. Very recently, some companies were in and out on 1st of April. So there was some allegation on SEBI that they did some partiality in including some company in some index. So SEBI came with very clear clarification that it is an automated process based on rules, and the rules, they have 4 factors into it, and these 4 factors basically decide what company will enter into what index or what rank. Similarly, the last block, 251st to 500, these are comparatively small companies as compared to the first 250 companies. They are called small cap companies. Till 2018, or I should categorically say till 1st of February 2018, SEBI was not very strict on mutual fund companies, how to define your fund. There used to be fund with 70% small caps being called as large cap, or vice versa. But SEBI came with strict rules and imposed several restrictions on mutual fund companies from first quarter of 2018, saying if you are calling X fund as small cap funds, it has to have this much small cap shares. Similarly, flexi cap, multi cap, large cap, mid cap, every kind of fund was defined by SEBI, and every fund house was forced to rename their fund or restrict their fund within that block. So before 2018, people used to give extraordinary returns in their fund by changing the structure of the fund, which was restricted by SEBI in 2018. So from last 4 or 5 years, this absurd returns of mutual funds have stopped. Now they stay within the block, and their returns are comparable within the block. Now, when I talk about comparable, all these blocks are compared to their respective benchmark, or the benchmark means index. SEBI has around 15 such blocks, and every fund is supposed to set a benchmark that if I am large cap, I have a benchmark of large cap index, and I will report my returns in comparison to the large cap index. So similarly, these companies have these reportings parallel to those indices. Now, we have actually learned quite a good amount of knowledge in last 3-4 sessions about active funds, and last session by Dr. Kunundu sir had very good information about index funds also. Now, these are basically two categories of funds that we have in the market: actively human managed funds, or called mutual funds, or replica of these indices. They are of same proportion what SEBI has defined, so they cannot deviate from that proportion, and periodically, as the SEBI will change that proportion, they will have to buy sell those shares and change the proportion. If SEBI says take out X from this index, they will have to sell the whole bunch of it and buy the new bunch which SEBI has advised. So this is called auto shift within index funds. Humanly managed funds basically work like this. They pool money, and the fund manager chooses, he cherry picks with his wisdom. I'm not saying that it is no science. There is a science. There are good fund managers also, as there are good lawyers in the world, there are good doctors in the world, there are average doctors in the world. So similarly, there are good, average, and poor fund managers also in the world. And once they choose their stocks, they invest in them, and the returns, good or bad, tells that fund is good or bad. Similarly, when we talk about index funds, they replicate the formula given by SEBI. So here, nobody is supposed to apply his own mind. It is something like machine doing a job based on the formula given by SEBI. Now, interestingly, just think about it. Fund manager has a job fighting these formulas. His full-time job is just to fight these formulas. He has to give a return better than this formula. And these index funds are designed in a way that they give almost near this formula. I must say the error is less than 0.1% in majority of funds. If you look at the long-term investment, maybe weekly or daily basis, errors are more in some of the index funds, but in majority of the index funds, if we see long-term return, the error is never ever more than 0.1% or so. So for mutual fund guy, the whole life lies in replicating or reaching near the index. Some reach, some don't. I will give you statistics coming up. How many reach, how many don't. They call this reaching or outperforming, that we outperform. And by the name of this outperformance, they charge so much fees from you, which an index fund can't. No, underperformance is a truth, is a fact. And similarly, outperformance is majorly a myth. Now, this is 2009 till 2018. Look, almost 80-90% funds underperformed. In 2018, 93% funds underperformed. As I said, in 2018, SEBI introduced the new structure of funds, and it became impossible in 2018 to sustain with SEBI rules, and 93% of the funds, they underperformed in 2018. It was very bad year for mutual funds because of the SEBI rule restricting them to limit their funds to what benchmark they are following. Now, next is this year, 2022 performance. This is official S&P data released on 31st December 2022. If you look at the Indian large caps, almost 85% in 1 year underperformed. If you look at 3 years return, almost 96%. If you look at 5 years return, almost 93%. Large cap funds, mutual funds underperformed the index. If you look at the ELSS, 5-year returns, almost 95% ELSS underperformed their respective index. In small cap, mid cap, since the base is so large, you have 350 companies to choose from. It's being a large base. Yes, a good fund manager can give you a good choice of stocks, undoubtedly, but still 50% of these funds underperform. It is not 5, 10, 20, 25%. It is almost 50 to 55% of small cap, mid cap Indian equity mutual funds underperform the index. So just do not assume small cap, mid cap mutual funds, they give you better return than the index funds in the same category. There is a 50% probability your fund is performing low. Mutual funds depends upon so many things. The person who is managing, the AMC and its seriousness. A lot of AMCs, for example, recently L&T, it was doing so good, but they lost interest into the business post-COVID era. BlackRock lost interest into their Indian holding. So this AMC seriousness is something you get trapped by returns into a small AMC, which loses interest into their business, and you start losing your returns into the long-term investing. This happens so frequently. There are so many examples in last 20 years. General people don't even understand what exactly it is. They believe that they have invested in a mutual fund, they invested in an equity. After 10 years, you don't remember the name of the fund and you are still invested into it. Forget about the performance. This is a routine story of a retail investor. Everyone will not run after year-on-year return, their alpha, beta, and other things, and will judge. It is impossible for an retail investor, especially who is into the profession of serious profession like pediatrics, earning his bread and butter through pediatrics, will not judge it so frequently, so religiously. Third, the size of the fund that you have. Mutual funds depend upon the size of the fund, but index funds, they do not depend upon the size of the fund because they are supposed to replicate something. It doesn't matter to them you have less money or more money. If you have more money, then also it is good. If you have less money, then also it is good. Similarly, expense ratio, because smaller the fund, it bites you more. Larger the fund, it will definitely bite you less. Plus, as soon as this mutual fund will start losing its shine, you will tend to sell it. If you're smart enough to identify that it has started losing its shine. Now, the biggest problem is you have invested this money for 20 years and after 7 years or 8 years, you realize this fund has started losing its shine. Now, what will you do? You will sell it. What that means? You will have to pay 10% long-term capital gain then and there itself. and reinvest the same money into another fund. And when you will need money, you will pay another 10% long-term capital gain. So you are made to pay LTCG twice because your fund failed. So this is another very big drawback of a mutual fund, which was not there before this LTCG rule. So people used to play a lot, but now it has become impossible to play with funds. This is a very popular fund, mid-cap fund, very inconsistent. It became no star to 3-star, then again 2-star, again 4-star, 5-star. I have not picked the recent 3 years investment, otherwise somebody will cash the fund. Now it has again become almost 2-star fund. So this is the inconsistency of a mutual fund. But if you look at an index fund, it will always be 2 or 3-star. It will never become 4 or 5-star fund. But it will always be a 2 or 3-star fund. It will never ever disappoint you. Now, can these fund managers pick good stocks? There is enough evidence. You should read Burton Malcolm model. He studied this for 30 years and published huge amount of data in 1970s that monkeys are better fund managers than the actual fund managers which were there in USA. And he proved with mathematics that monkeys choose better stocks. So actually fund manager business is a monkey business. They just tell you that we choose better and we do better. But in long term, they do not perform consistently. And it is impossible for them to, because you can say that this performed better. You cannot say that this is going to perform better in coming years. So this is very important to understand. At the end, you don't buy good funds. You buy what your friend is telling. What I will tell, you will buy. What is the flavor of the season? Newspaper, whatever that is coming in the headlines, you will buy. Who is giving more ads in the newspaper? You will buy that. Sometimes there are celebrities promoting mutual funds, you will buy. So you buy hot funds. And these hot funds or so-called 5-star funds, they change every year. So you tend to buy this year X, next year Y, and then Z. So what will happen? There will be a pile of mutual funds with you in few years because you are running after star rating or the good funds or good return funds. And most of these funds which perform good in the specific year are on their up cycle, on their best cycle. And from next year, when you buy, they stop outperforming or they stop performing. And then the realization comes that, okay, this fund is bad. Then you stop this fund, you go for another fund. This gentleman, the father of index funds, or the guy who introduced Vanguard to this word. Now, if you know, Vanguard is one of the largest mutual fund companies of the world, and Vanguard 500 index fund is one of the largest index funds of the world, which it is a fund which holds all 500 S&P companies in tune of 5% minimum. So look at this fund alone holds 5% of the equity market of USA. That's how big Vanguard 500 index fund is. As I was initially in the very first slide said that the world is moving from buying equity to mutual funds to index funds. So similar story of index funds, India has also started. There are around 130 index funds and around 120 ETFs currently in India of all blocks, all categories, and slowly they are getting picked up by people. And these are 4 major categories, and these are the weightages based on free float methodology. The only one thing fund manager says that I sell the poor and buy the good. So this is called auto shifts in index funds. They automatically get shifted out and shifted in as per the free floating formula. And you don't have to buy or sell that equity. Interestingly, you don't have to buy or sell the fund, interestingly, when that happens. This is this year's inclusion and exclusion, which happened in Nifty Next 50, just last month. So similarly, auto shifts happen in all categories, in mid cap as well as small cap. So you just have to hold that specific index, and rest is done by the company or the mutual fund company automatically. There is no individual or the brain involved in doing it. Now, when we talk about index funds, in most of the talks of mutual funds, people say index funds give decent returns. I have not been able to understand what does that decent mean. By saying decent, do you mean to say they give less returns in comparison to mutual funds? If somebody believes that index funds gives less returns than mutual fund, then I think it's the blunder that they are making in their investment. It is not like that. Yes, some mutual funds give excellent returns intermittently. This is a fact. If you pick 10 years data, there will be 2 years that they will give exceptional return because they have invested in those sectors which were supposed to multiply fast. But when this year, next year, next to next year, the fund managers also doesn't know. So they keep, for example, AI is expected to multiply fast. So a lot of fund managers are investing into AI these days. But when will AI multiply fast? They don't know whether it will happen in 24, 25, 26 or 27. They are not aware of it, but they know it will happen. Auto industry and consumer industry is supposed to multiply very shortly. So everyone is invested into that. Would this shortly will be in 2023, 24, 25? They also don't know, but they are sitting on it. Now, these are 3 years return of large cap ETFs. I have to go left or right. You can see they are in the tune of 23% CAGR of last 3 years. This is mid cap index funds, 3 popular funds. Their CAGR is of last 3 years is 33, 34. This is very decent, I must tell you. This is not less than anything else. This is small cap 3 years. This is Motilal Oswal Nifty Small Cap 250 fund. This is last 3 years CAGR of this fund. This is 37%. This is something I don't disclose, but this time looking at so many talks, I thought I must disclose my portfolio. Last 3 years returns of my index funds portfolio is this. And I must tell you, I am more than happy. I am getting alpha of 10% of my desire. So I am more than happy with this. So I don't see getting more than this. Maybe you are getting 50%. I am very happy that somebody is getting 50%, but my desire, my aim, I am not into the race of getting more return. My money is giving return. This is my desire. So this return is good enough for me, more than enough for me. And this is a SIP return, I must tell you. It is not lump sum investment return. This is a SIP return. And last 1.5 years, everyone knows was so bad. Despite of that, this is the return. Now, these most popular ETFs, a lot of people say normal ETFs or funds, they are small. Look, SBI Nifty 50 ETF is 1,43,000 crore AUM. Can you get me a mutual fund with this amount of AUM? You will not. You have to get 10 funds to match this value of AUM. There are half of the companies, half of the mutual fund companies worth is less than this. And this single fund is 1,43,000 crore fund, only a single fund. Why this is so popular? 90% of the corporates, those who wish to invest in equities, invest through this ETF. They invest it for long term. And this is that is how this ETF is so popular. It is not traded much. It has a very low or average trading value per day, but it has a very high amount of fill it, shut it, forget it. Similarly, I don't want to talk about expense ratio today, because every time when I talk about index fund, I talk about the expense ratio. So it becomes a point that it is the only benefit of index funds. No, it is not the only benefit. If you look into the expense ratio, it is a big benefit, but it is not the only benefit of index fund. It is just one of the benefits. If you have 1 crore portfolio and your index fund is at 0.05% expense ratio, you are just giving 5,000 rupees a year. But in a mutual fund, if you have a 1 crore portfolio, you are giving 2 lakh rupees to the mutual fund company only. I think it is absurd, too big. So please, friends, for long term, please fill it, shut it, forget it with index funds. For horizon more than 10 years, for horizon equivalent to your goal of retirement, this is very much important. And another concept I always talk as a last slide of my talk is dead man's portfolio. It's a huge concept. If you look at the portfolio which gives the best return, it is the dead man's portfolio or widow's portfolio, who doesn't know that her husband was investing into equities, and suddenly one day she discovers a portfolio which was not touched for 10-15 years because the husband died long back. This is the portfolio which has given the best returns over a period of time. So
I believe it had a warmer.
If you do not buy, sell your shares for long term, then your portfolio gives the best return. So index funds are similar. Buy, fill it, shut it, forget it. You don't have to worry about mutual fund company. You don't have to worry about fund manager. You don't have to look at Alpha, Beta, Santorini, anything. You just have to keep sitting on it for long term. It will give you an average return of those 20 years, but it will be better than any other mutual fund. Maybe 1 or 2 mutual fund might perform better than it, but God knows you would have invested in that or somebody else. Nobody knows it. Thank you, sir. Sir, you're mute.
Thank you, sir. It was a wonderful talk. So there is a few questions in the chat box. So one of the question is why less index funds are available in mid cap and small cap category?
See, index fund, as I said, index funds are not sold, they are bought. You have to buy them. So the industry doesn't want to sell you index funds. They don't earn anything out of index funds. So it is the pressure of the investors like me now, those who are going 100% into index funds. I stopped investing 4 years back into mutual funds, and I shifted all my new investments into index funds. So similarly, the huge trend is on now. As you say, buy vanilla flavored term plan in insurance. So this slowly this rhythm of buying index funds will come. So mutual fund companies will be forced to start. So these small mid cap and small cap funds were not started in India by mutual fund companies because they will not earn out of these funds. If we all start buying index funds, their earning will stop. They won't earn anything. bread and butter is by selling fancy mutual funds, advance, advantage, multi-cap, these flexi cap, these are the funds they earn from. They tell you we do fancy things by saying so many fancy words with mutual fund. This is how they earn. They will never earn good amount of money with the index funds. Some of the index funds are of so low value that they hardly give them their expense. And those who come with high expense ratio, no retail investor will buy them. No advisor gets more than 0.1% commission. In a mutual fund, advisor gets 1% commission every year on the value of your corpus. It is not the entry point, it is every year on your corpus. If your corpus is 1 CR, he is getting 1 lakh every year from your funds. But in index funds, he's going to get only 1,000 rupees. So why he will compare 1 lakh rupees versus 1,000 rupees? So no mutual fund company is interested in index funds. It is the retail investor who has to go and buy index fund. Nobody is going to serve you index fund.
Okay, thank you, sir. The next question is, what is the difference between Nifty ETF and Nifty index fund?
For ETF, it is exchange traded fund. It is the same as index fund, but it is traded daily on NSE. You need a demat account to buy, sell it. You have to sell and buy it on live market. But index fund is like a mutual fund. They have a NAV and daily settlement. So when you apply for buy or sell, you get it on the daily NAV. That is the only difference. Otherwise, in long term, they are same. It is better to go for an index fund if you are a new investor and you don't have demat account. But if you have a demat account and you can buy, sell easily on your own through a demat account, go for an ETF, because in ETF, you get flexibility of putting rate that I want to sell it at this price. So maybe you might get 1%, 2% more than the average NAV. Otherwise, both are same in long term.
Thank you, sir. The next question is, what is the ideal mix of index funds, large cap, mid cap, small cap index funds in one portfolio?
See, it is very simple. 55 to 60% should be the large cap, or within large cap, there are two index funds, that is Nifty 50 and Nifty Next 50. So around 30% should be Nifty 50, around 25% should be Nifty Next 50. Another 30% should be mid cap, rest 15-20%, whatever is left with you should go into the small cap. This should be the proportion. If you are a conservative investor, you do not want to risk too much into the equities. But if your appetite is little more in taking risk, you can swallow the volatility of the market, and you have a very long term, like 15-20 years of horizon. You can increase small cap exposure to 20-25% and mid cap exposure to almost 30-35% and rest into large cap. Then your returns will be a little better in comparison to that, compared, as I previously said, the conservative percentage.
Thank you, sir. The next question is, for portfolio stability, should we invest in large cap or index funds?
So by this, you mean by large cap mutual funds versus index funds?
Large cap index funds, yes. Nifty funds, Nifty index funds versus large cap index funds. Large cap mutual fund versus Nifty index funds.
I think, see, for mid cap and small cap, we do not have enough evidence, although last 3 years data I have given you, which is very promising for mid cap and small cap, because recently we have started with, India started with the mid cap and small cap index funds from last 3 years only. But for large cap index funds, enough data that in coming years, there will not be any large cap mutual funds available to you. Only investment into the large caps will go through index route. So this,
thank you, sir.
Yeah, please.
Sir, can you name any Nifty IT index fund? Somebody is asking.
There are two Nifty IT index funds. One is by ICICI, another is by Nippon. Both, one is by ICICI also. These are ETFs. And you can buy these ETFs. These are exchange traded funds, Nifty IT, SBI IT. So these are the funds one can go for IT sector. But again, my personal view is please do not go for thematic sectoral funds. That is a separate advice from this advice. Your majority of all these funds or all these blocks or indices have enough IT exposure into them. That is more than enough. By any mean, if IT will fail, your IT specific sectoral fund will fail. So just by assumption that you believe that IT is fallen a lot and will do better, do not enter into specific thematic or sectoral fund.
Thank you, sir. Dr. Neeraj is asking, name an index fund. Instead of naming an index fund, can you please tell us how to select a good index fund among the same category?
See, if you want to select good index fund, number one, look for AUM, which has the largest AUM. Number two, look at the tracking error, which has the least tracking error. Look for a company which is into the serious mutual fund business and has more than one index fund with good amount of AUMs. This will prove that this company is serious about index funds and will continue with index funds in a long term. Nothing else you need to look. Rest of the things are taken care by automated process.
Sir, regarding the tracking error, where the information is available in value research only?
No, tracking error is reported by most of the individual companies. For example, if you look at the SBI website, SBI mutual fund website, every index fund has a column of tracking error written on it. So you will find a tracking error on it. Plus, you can compare yourself. It is not a rocket science to look at the tracking error. Just look at the correct benchmark it has. For example, Nifty 50, look at the 10 years CAGR of Nifty 50 TRI and compare it with the respective index fund. You will find the tracking error. It is not a rocket science to look for a tracking error.
So if the tracking error in between is becoming more, can we stop it and reinvest in some other index fund in between?
Yes, definitely. Definitely the same formula will apply like a mutual fund fails. And similarly, if index fund can fail, but I have not seen any index fund failing so far. Maybe for certain period, it might give you a higher tracking error. That is usually for weeks and months, not beyond that. And it gets adjusted later on. But do look at the benchmark it is placed at. I have seen value research quoting wrong tracking error by comparing it with wrong benchmark. Value research compares all large caps against NSE 100 TRI. Even Nifty 50 and Nifty Next 50 both are compared to NSE 100 TRI, which is wrong. Both are different indices. You have to compare to a respective index, not to NSE 100 TRI. So there is a probability if you are looking at a value research, there it might be reporting a wrong tracking error of certain mutual funds or certain ETFs.
So with the follow-up of this question, Eli Raja sir is asking, which is the best app or website to look at or to diagnose the index fund?
Sir, you don't need any. You don't need any app. You just look at the AUM of that and look at the seriousness of that company. Nothing more than that. Tracking error is one thing that one should look, but don't even look at that. There used to be a website called indiaetf.in, but that has stopped functioning from last 6 months. I don't know the reason. Some private guy was making it happen. He used to put daily navs into it, which used to tell all this at a single glance. There is a filter in Money Control, which gives you all the index funds on a single screen, and you can compare all these on a single screen. But Value Research has a problem. They do not promote index funds and they do not give you all index funds on a single screen. You have to find them individually and compare them. Again, I would like to put an emphasis. Nobody is getting money out of index funds, so there won't be any tools to identify good index funds. And all index funds usually are same. They are not different. That is another story. So try less to evaluate index funds. They are almost mirror images of each other.
Sir, thank you, sir. The next question is, if I have a brokerage account and a mutual fund account, what is the percentage for ETF and index funds?
You mean to say what is the brokerage?
No, sir. If I have a brokerage account like Zerodha as well as in the mutual fund account like Grow, so how much percentage should I invest in ETF and index funds is the question.
Again, it is a personal question. I always feel my personal is, if you are a passive investor, you don't want to get into evaluating funds, stocks for your investment, and you just invest and keep it as your future investment, 100% should go into the index funds according to me. But if you still ask me, all your large cap investment, which is around 50 to 60%, should go into the index funds. Rest 40, you can still decide between mid cap and small cap as mutual funds. But time will definitely prove that even that mid cap and small cap index funds are better than the mutual funds. Then you can think about it. So very, very weird question. So answer is sorry. I'm really sorry.
I'm just reading out the questions. Ayush again is asking where to find information about index funds. Already, I think you have answered it.
You can Google it. You can Google it. There is good amount of information on Indian index funds, Indian ETFs, and off late there are good number of people who have started promoting ETFs and index funds.
Okay, sir. Thank you, sir. I think the questions are over. So it was a wonderful, simple, exciting, and eye-opener presentation, sir. For many people who are investing in active funds, especially after coming from an active fund mutual section to index funds, I think it has opened many eyes. Ajay sir, are you there, sir?
Yeah, I'm there.
Thank you, sir.
Thank you, Dr. Harish Gopal, sir, for moderating and closing the session. And Dr. Vipul Jain, sir, fascinating, mesmerizing, attractive, your talks as usual. So much of knowledge, the punchlines and the slides preparation and the amount of conviction you have in the index fund is remarkable, amazing, sir. Thank you for educating doctors, pediatricians in our group. And I'm sure they will remember for a long time your key messages, what you have given.
Any questions about index funds, please ask in the WhatsApp group, sir. Thank you.
Yeah, we have a WhatsApp group, as you all know. Any questions further to Dr. Vipul Jain, sir, or any index fund questions for the next 1 week, the theme of the WhatsApp will be index funds. And sir, if he has time, he will answer us. He's an active participant there. And you can also write any further questions there because of the lack of time. I'm sure the questions are more, the time is less. Just to conclude my closure before, if Dr. Yashwant sir, if you are there, the President PATS, please be the next ready to give your closing remark. I like to show this book which sir has mentioned. I think you can all see The Random Walk Down the Wall Street by Burton Malkiel. Burton Malkiel, sir has alluded to this book, and I'm also really fascinated by this book. This book has written by the professor of Princeton University, economics, Burton Malkiel, in way back in 1975, and I have in 2019 edition. And it's a really good book. And what Monkey's example of blind-headed people who throw darts, they can select funds, companies, and it will make equally good returns comparison to the very intelligent fund manager. So I thank Vipul Jain sir, wonderful sir. And kindly continue to be in our group and teach our doctor friends. And if Dr. Yashwant is there, please give your closing remarks. Dr. Yashwant sir, President PATS.
Thank you, sir. Vipul Jain, sir. It was very simple and eye-opener. I have listened through Satish Vadapalli regarding this Nifty index funds. He emphasizes on Nifty index funds. And really, after listening to your 45 minutes talk, I'm convinced that ETF, there is no much difference between ETF and Nifty funds. Thank you so much for educating us. Thank you.
Thank you, sir. Thank you. Pleasure is mine, sir.
And just a closure announcement, smart way to invest in Nifty VIP model. Dr. Satish is going to talk next 14th May. We don't have any talk on the next Sunday on 7th May. Then on 21st May, we have basics of stock market by Chape Soren. Dr. 28th May, again, he is going to take a part 2 of the stocks, that is how to build a core portfolio. There were a lot of questions last time, and Dr. Chape Soren, an expert of expert in the stock market, you are seeing him posting wonderful messages. So those learners, newbies and youngsters, don't miss this program. Thank you very much. And we now leave the session. Thank you very much.